Visa. We all know it, it's an absolute powerhouse in the financial world. But right now, it is sitting in a really fascinating spot. The stock is currently trading just 2.6% below its all-time highs. Now, for a lot of companies, hovering that close to an all-time high is a clear sign of absolute victory. But in the financial markets, it can sometimes be a signal of exhaustion, a top. So are we looking at a bullish consolidation, meaning the stock is just catching its breath before rocketing even higher? Or are we seeing a top signal where the momentum has literally just run out? Let's open up the hood and see what the data is actually telling us in today's explainer.
Because there is a glaring contradiction happening in the market right now. If you just look at the surface-level data, Visa should absolutely be breaking out and hitting new records daily. Revenue is up 14%. Earnings completely beat Wall Street estimates. Even legendary investors like Bill Ackman are actively buying in. And yet, the stock is just stagnant. It's hovering that 2.6% below the all-time high, essentially stuck in the mud. So, with all these massive tailwinds and institutional buying, why isn't Visa breaking out? Well, to understand the hesitation, we first need to look at exactly what is going right.
Okay, let's dive right into this. Section 1. Rock-solid fundamentals and the bull case.
Just wrap your head around this number, $4 trillion. In its most recent quarter, for the very first time in the company's entire history, Visa's payment volume surpassed the $4 trillion mark. Let that sink in for a second. That means $4 trillion of global economic activity flowed over their rails in just a 3-month period. That is wild. And alongside that, the number of processed transactions grew by a really robust 10%. Basically, consumers are still out there swiping, tapping, and clicking, and Visa is acting as the toll booth on that massive global highway.
And, as you might guess, that toll booth translates directly into hard cash. Looking at the fiscal Q3 highlights, the numbers are rock solid. Revenue came in at $11.63 billion. That's a 14% jump year over year, and it actually beat analyst estimates by a cool $250 million. On the bottom line, non-GAAP earnings per share hit $3.32, which is an 11% increase. What this really proves is that the consumer is still spending. And in a massive show of confidence, management actually went ahead and raised their full-year guidance for both revenue and earnings.
But it's not just about managing the current volume, it is all about strategic positioning. Visa recently announced a 7% workforce reduction, which impacts about 2,600 jobs. Now, usually, layoffs are a major red flag, right? They signal distress. But if we dig into CEO Ryan McInerney's strategy here, this isn't just simple cost-cutting. This is a very aggressive, calculated pivot. They are actively freeing up capital to build out their artificial intelligence and stablecoin infrastructure. This is them pivoting to the next generation of payments, basically ensuring that they own the future just like they own the present.
Which brings us to Section 2, the valuation elephant, or pricing imperfection.
Yes, the fundamentals are stellar, but we have to talk about the valuation elephant in the room, because this introduces the first major reason why the stock might be struggling to find that breakout momentum. Visa is currently trading at about 31 times its earnings, compared to its 5-year historical average of around 28. That 31x premium means the stock is essentially priced for absolute perfection, leaving literally zero room for error. Any slight misstep or even just an average quarter can trigger a sell-off because the expectations already baked into the price are so incredibly high.
Now, despite that really rich valuation, Wall Street and analysts are almost universally waving a green flag. The major players are all saying buy. The average price target is sitting at $416, which implies a 14% upside from current levels. You've got Bernstein up at $450, Goldman Sachs looking at $438, and Deutsche Bank targeting $430. So the smartest guys in the room are looking at that 31x multiple and saying, you know what, it's worth it.
But here's where the reality of the market clashes with Wall Street's glowing recommendations. Over the last few weeks, Visa stock has been stuck in a remarkably tight trading range, just endlessly bouncing between $359 and $366. So why the stagnation? It's a classic standoff. Buyers are staring at that high 31 PE multiple and waiting for a better, cheaper entry point. Meanwhile, sellers are looking at the stock hovering near all-time highs and deciding it's the perfect time to just lock in their profits. It is a tug of war, and right now, neither side is winning.
So let's get into what might break this standoff in Section 3, the margin red flag. This might actually solve our core mystery.
There is one micro detail hidden in the earnings report that Wall Street is watching very, very closely. It's a potential red flag that might explain exactly why the stock is stuck. We're looking at a clear margin squeeze. In Q2, Visa boasted an incredible net margin of 53.6%, which drove a massive 28% year-over-year profit growth. But just one quarter later, in Q3, that margin dropped to 48.4%. That is a 5 percentage point decline in a single quarter. For a company of this size, that is monumental. Consequently, that profit growth plunged from 28% down to just 6%.
So what exactly is eating into the bottom line here? Well, it comes down to a surge in a few specific pressures: rising technology costs, increased marketing expenses, heavy investments into AI, and the recent acquisition of the cybersecurity firm BioCatch. Now, there are two ways to view this, and we really need to look at both impartially. The bull view argues that these are absolutely vital temporary investments for future growth. They're building the infrastructure for the next decade. The bear view, however, argues that Visa is losing its operational leverage and that those glorious 50+% margins might just be a thing of the past.
Because of this margin uncertainty, keep this number right here in your head: $343. This is incredibly important. It's the critical support level on the charts. If Visa reports next quarter and those margins continue to fall, technical analysts expect the stock could slide right down to this $343 level. It's the floor that the market has established, and it's the line in the sand everyone is watching for sure.
All right, let's zoom out a bit. Section 4. Future competitive threats and structural risks.
Let's pull back from the immediate quarterly numbers and look at the long-term horizon. Beyond just margins, Visa is facing some real structural risks. The world of payments is evolving rapidly, and Visa's historic dominance is being challenged by emerging technologies that threaten to bypass traditional card networks entirely. First, Europe is actively building alternative payment rails to reduce their reliance on American networks like Visa and MasterCard. Second, we have stablecoins. They're rapidly gaining traction for cross-border settlements because they're faster and often way cheaper than traditional wire transfers. And finally, agentic commerce. Just imagine AI agents haggling and making micropayments on your behalf. It sounds like sci-fi, but it is happening right now, completely outside the credit card ecosystem.
But Visa isn't taking this lying down. Their ultimate moat is their sheer size: 4.3 billion cards in circulation globally, accepted at over 80 million merchant locations. That is a level of unmatched scale and reliability that simply cannot be replicated overnight. Visa's argument is that regardless of whether the future is AI, stablecoins, or traditional credit, the money will ultimately flow through their deeply entrenched network. And honestly, history has proven them right so far.
So let's bring it all home. Section 5, the bottom line: bull versus bear.
Okay, we've looked at the massive scale, the high valuation, the margin squeeze, and the future threats. Let's bring all this evidence together to give you a clear, objective summary of the conflicting signals surrounding Visa right now. On one side, you have the bull case. The technical setup remains remarkably strong, management is making really smart pivots into AI and stablecoins, and analysts see a clear path to $416. Their advice is to buy the dip. But right across the aisle is the bear case. The stock is expensive at 31 times earnings. Those profit margins are undeniably declining, and the long-term structural competition is very, very real. When you weigh these two sides, the risk-reward at these current price levels feels incredibly neutral.
Which brings us to the immediate, actionable technical level you need to watch: $356. If you are watching the stock, this is your barometer. If the price dips but holds strong at $356, technical analysts suggest it confirms a buy signal. However, if that 356 level breaks and the stock falls through it, buyers should probably hold off. Why? Because you are very likely going to get a much better price closer to that 343 support level we discussed earlier.
So I'll leave you with this final thought after looking at all the data today. We have record-breaking transaction volumes clashing directly with shrinking profit margins and a premium price tag. The data is all laid out right in front of you. Based on the fundamentals, the valuation, and the technicals, are you buying Visa here or are you waiting for a better entry? Take the data we unpacked today, apply it to your own strategy, and keep exploring. Thanks for joining me on this explainer.